It's 3 a.m. The London session opens, volatility spikes, and your exact setup materializes perfectly. But you are fast asleep. A violent sweep of liquidity creates a fair value gap, triggering a textbook 100 pip profit opportunity. By the time your alarm rings at 7 a.m., the move is entirely over. This is the discretionary trap. Your manual analysis was flawless, but human hesitation, fatigue, and the basic need for sleep ruined the execution. In 2026, retail traders have gained access to the high-frequency tools once reserved for hedge funds. New tech stacks and AI co-pilots bridge the gap that previously required a computer science degree. System-driven traders capitalize on these market moves around the clock. By automating your edge, you ensure every entry is handled with machine precision, while you focus on the macro narrative. To automate a strategy, you must eliminate the concept of maybe. A computer cannot process what a setup looks like, so every ounce of subjectivity must be stripped away. This diagram shows a standard bullish order block. To the human eye, it is easy to spot, the last bearish candle before a sharp, impulsive upward breakout. But an algorithm cannot interpret this visual shape. It requires raw mathematical parameters. We translate this into Boolean logic, strict if-then statements. The code simply checks, is the close of the first candle greater than the high of the second, and is the volume above the 20-period average? A fair value gap, or FVG, works the same way. The machine reduces the three-candle structure to a strict mathematical equation, measuring the exact distance between the wick of candle 1 and the wick of candle 3. Quantifying these visual patterns into rigid logic guarantees flawless execution. The system will enter at exact price points and set the exact stop loss every single time, even during chaotic peak volatility. Writing that code used to be the main bottleneck. Today, large language models act as your on-demand senior developer, handling the syntax while you provide the strategic logic. But prompt engineering requires specificity. Asking an AI to write a trading bot generates useless errors. A professional prompt dictates the exact parameters. Write an MQL5 script targeting a 15-minute gap, risking exactly 1% of equity, with a hard stop 2 pips below the entry. When the code hits a snag, the workflow becomes a dialogue. You paste the error logs into the AI, and it identifies logical leaks, like suggesting a missing time filter to prevent the bot from trading during a zero-liquidity bank holiday. Using these co-pilots, you act as a system architect. You spend your time designing high-level logic, while the machine manages the tedious burden of writing clean syntax. This line graph illustrates the fatal flaw of poorly built algorithms: curve fitting. A bot might show a 95% win rate on historical data, only to suffer a dramatic plunge the moment it hits live markets. When you over-optimize your parameters, the bot simply memorizes meaningless market noise. It tightly wraps around past random spikes, rather than discovering a repeatable edge. The mathematical antidote to this over-optimization is a process called walk-forward analysis. This diagram breaks down the process. You optimize the strategy on one historical dataset, then you verify its stability on a completely unseen segment of data to ensure the performance trendline maintains a steady slope. Verifying your strategy's mathematical robustness across varied data is significantly more important for your survival than chasing a theoretically perfect historical win rate. Once your algorithm is tested, it is time for live deployment. But a flawlessly coded strategy will still fail if it operates in a vulnerable technical environment. You need continuous connectivity. This requires a low-latency virtual private server, or VPS, along with heartbeat scripts that alert you if the bot ever loses connection to the broker. Without safeguards, a simple connection error or an automated revenge trading loop can wipe out a funded prop firm account in minutes. To prevent this, you implement a hard-coded circuit breaker. If your daily drawdown limit is hit, the mechanism instantly freezes the bot, closing all positions and disabling the system until the next day. Building strict environmental safeguards protects your system from technical outages and from your own emotional interference. The most effective operational state for modern traders is the hybrid model. It combines human macro analysis with the ruthless micro-execution of a machine. Here is the exact workflow. You, the human, determine the overarching daily narrative. If your analysis points to a bearish euro, you toggle the bot into a sell-only mode and let the machine execute all the precise entry criteria. Algorithms offload the biological burden of execution. This leaves your mind free to analyze the macroeconomic shifts and geopolitical developments that actually move the currency markets. Stop manually clicking buttons in the dark. Document your strategy definitively, translate your edge into code, and start building your automated system with FXNX's NX1 platform today.